Oh, I don't know where that went. Okay. Right, back to this. So we finished our initial planning in phase one, sort of got our directions on what we're actually investing for, all of the planning, all of that sort of stuff. We've created our investment portfolio or optimized what we already have. And so now we're sort of in that maintenance phase where we've put everything together and we want to make sure it all stays in the right place and that we're having tax efficient returns, that our estate planning stays held together, and that our portfolio doesn't drift too far off of our path. So today we're going to dive a little bit into estate planning maintenance. So we'll just go over some general estate planning concepts and things to make sure to look out for. But last time we talked about portfolio monitoring. So really just making sure that the goals and objectives continue to be served by the asset classes and types of assets that are in the portfolio, that your cash needs are still there, refilling cash positions as they get drained down, and just monitoring that risk tolerance on a semi-frequent basis, just to make sure that things don't start, really getting too volatile. That's when it might be a good idea to be looking at things like beta and standard deviation to understand that, well, if the volatility of the portfolio is greatly increasing over time, if the last couple times you've measured it, you start to see those numbers rise, you might want to think about how that's going to affect your downside risk in the future. So knowing when to sort of pull back in from the stock market or push back in at different times is helpful. And then obviously we talked about all of the sort of stuff that you should do on a frequent basis. So just making sure that you're kind of up on market news and economic indicators and such, and really not using it and creating like this little strategy where you're going to get the best returns and have little losses and all this stuff, but just kind of understanding vaguely the environment that's going on, vaguely the sentiment that is going on in the market, and just understanding how you're positioned in it in a very, very general basis. Briefly reviewing updates on tax code or financial legislation is super important, because if you lose a benefit that you were using previously and you go to use it again, you're probably going to get hit with some sort of tax or penalty. And so if you don't know what you're utilizing, or you don't know things about like backdoor Roth conversions or mega backdoor Roth conversions, things like that, where it's kind of technically a loophole that just has not been closed in decades and decades, it's possible the IRS could go, we're going to shut that off, and now everything that you've done previously, we would like to have a look at that. So it's important to understand what's happening in the tax law updates, especially with bills like, Trump's big bill that he just throws on the economy all at one time. It's important to, regardless of how you feel about what the impact is going to be, to look through there and see if there are things that can help you in what you're doing. Staying up on educational stuff, listening to things like financial podcasts, or really like Morningstar and Bloomberg, and just large firms where their whole thing is to stay in the know and to understand sort of the information that's out there, and not necessarily people who are trying to tell you how you're going to make more money or lose less money. It's not really about the strategies. It's just about financial education and keeping yourself learning about possible tax benefits that you could have, possible estate planning benefits, possible planning benefits, or all of the different things. Because there will be little tiny details that, I'll miss in this presentation that could be really important for your situation. So to be continuously taking in new information so that you always are aware of what things could be impacting you, super important. These are some of my favorite podcasts. Bloomberg Daybreak is it's my go-to, just quick, what's going on today? Like just what's going on today in the morning, just talks to me about, kind of what's going on currently right now. ETF Prime is great if you like products, if you like investments a lot, if you want to hear about complicated investment products. Bloomberg Balance of Power is like the one political thing I'll listen to because it feels very balanced in the way that it speaks. And All Worth Money Matters is a great financial planning focused podcast because it's financial planners who take guest calls and take questions about financial planning and investment stuff. So it's really good that's the best, in my opinion, contextually for everything that we're talking about, because directly asked will be questions about all of the stuff that we talk about. So All Worth Money Matters, if you want to just have that kind of in your brain consistently, I think that's probably one of the best ones to listen to. And then, like I kind of mentioned, looking at your portfolio performance, not necessarily judging it on a raw performance a metric, but just kind of looking at what are the positions that we've got in here? How are they, how are they moving in different directions? How far am I drifting away from my target allocation? Looking at your individual holdings and making sure that you don't have anything that's too ridiculously expensive for the product that you're getting, or you're not super concentrated in some sector without even knowing it. I mean, you'd be surprised, people will put together portfolios and they'll do this work, and then there's still a 30% tech concentration because they didn't really pay attention to most funds having that really high concentration in tech. So they end up at the end of the day with a portfolio that still has the same concentration that a total market index fund might have, but they think they've done all this work to avoid that. So just kind of looking at that and just seeing where are you distributed. And even if you have concentrations, just knowing what they are and being aware of what comes with that and if it's aligned. Reviewing all the distributions and income streams, things like systematic withdrawals from the account to making sure that they go to the right place, they're coming at the right times, you've got the right amount of tax withholding on them if they're from IRAs. So to make sure that if you are ending up with extra tax bills at the end of every year and you're just not really sure why, check on your withholdings on distributions from things like IRAs. It's really important. And any of those other income sources, just really knowing what they are and really totaling them together and being able to track them well. And then on a quarterly basis, this is when I really like to look at deciding if I need to make a rebalancing trade. Not necessarily that I'm going to trade every single quarter, but I'm definitely going to hone in on the quarter and think, okay, is this position where I want it to be still? Has it drifted to a point that's too far in my portfolio? Is it time for me to harvest some of this off and scooch it off in another direction, especially with the more concentrated stuff? So as we start moving up that diversification pyramid, as we start to get to things like really concentrated sector funds or managed funds or anything of the like, if those start really outperforming, that's a great thing for us. It's extra return, but it might be starting to skew the overall risk profile of our portfolio. And it might be time to trim some of that and spread it across the things that are at the core. So it's just important to look at that and really evaluate that. Personally, I do it on a quarterly basis, trade maybe anywhere between quarterly to annually. It doesn't have to be super frequent, and it doesn't have to be every single year. You can let a year ride if you want to. Important to look at tax planning as well. So if there's tax loss harvesting opportunities, like right now, yesterday, I just went through a whole bunch of accounts. I looked at a whole bunch of client accounts and noticed if I had a certain amount of tax loss to harvest, I took that and I moved it over to a position that either was of higher quality than when I was previously in, or is more aligned with the investment thesis that we have for our portfolios. So it's just a good opportunity, especially if you're going through this process for the first time. You're going, okay, hold on a second. This position doesn't really match what I want. If it's also at a loss, what a fantastic opportunity to claim some tax loss, move into the fund that is what you actually want, and move on from there. And then obviously for holdings, just look into the landscape of investment products that are available to see if there's lower cost or otherwise better options. Morningstar is a really good resource for this. They have a lot of information. Yes. Mike? Mike?
For people who, for people who are not hands-on, is this what you do to each and every account? And
Yeah.
if it is, if you had a whole bunch or a large firm had a whole bunch, is it possible for people to do that with their own minds, or are you using AI or algorithms to somehow go through an account? Because at a certain point, I would think it would become beyond what one could do in a day or a week.
Yeah, and so that'll come down to a couple different factors. I think one of that is the complexity of the portfolio. So just exactly how many different positions we're looking at. So I don't like to use just overly complex portfolios just for the sake of having more going on. If there's something that can be simple, like core equities, for example, like what is going to be the major equity focus for me? It's going to be total market index funds, or if the person likes value more, it's just value index funds. That's going to be a very simple position. So for me, that's one part of it is my portfolios aren't ridiculously complex, so it doesn't become super hard. It's not like everybody has individual stocks. I'm going back. That's why I've never really delved into direct indexing for, everybody. I don't want to deal with a ton of individual positions and getting that wrong. Another thing will be sort of the tools that are available. from a professional side, we have a lot of tools that make this process easier. One of them for me is the way that I manage portfolios is instead of building each client's portfolio holding by holding by holding, I have what are called sleeves. So for the sleeves, yes. So yes, exactly, sleeves. So it's just kind of like this sleeve holds a certain type of asset class in it. So for me, I use core equities, which is just sort of my broad diversified equity exposure. I might have equity income. So for equities that pay more dividends or preferred stocks or something like that. So there's two. And then I have fixed income. So for my bonds, I pick my bond funds, I put them in there. And then I have stable value, which is essentially short treasury bills, ultra short-term stuff. And for the most part, when I build a portfolio, it's just a mix of each of those sleeves. So it's like 4 different things. And so then I manage those sleeves individually. So if we have 3 or 4 different client portfolios and they all have a big fixed income position, that's fine. But I'm analyzing my holdings on the sleeves basis. So I'm making sure that every client that has fixed income, they should be in this or something similar. So if they have existing holdings and something fits, I can be like, all right, we can leave that. But I kind of have this ideal that I'm always trading to. So when I scan through accounts, it's really easy for me to just quickly go, okay, that's out of place, move it and move it to the thing I've already analyzed. So that's kind of like the big thing but yeah, at a certain point, yeah, it could top out. And if there's 1,000 different accounts that need harvesting every quarter, that could get a little intense. But there are a lot of tools available. And bigger firms will also, a lot of them will do model portfolios, or they'll use what's called a separate account manager, which is where they literally farm off that job to somebody else who charges them money or charges the client money realistically, but they'll do that on a reoccurring basis, on more of an automated basis for them. So there are a lot of tools available out there for us. Yeah, cool. All right, biannually, if you haven't already completed rebalancing in the quarter, this would be a great opportunity to look for it if it's necessary. But really just don't get too hung up on trades. You don't need to trade very often. You don't need to do a whole lot to make your portfolio work hard for you. You just need to make sure you're in the right risk category. You're not paying a ridiculous amount of fees for things that you don't need, and it's just moving in the right direction. Great time to do your holdings replacement. Again, replacing stuff that doesn't align with your strategy and replace them with new things. Insurance coverage review is great to do, looking at any of the different coverages that you have and just making sure they align. And really, like a lot of this is like, 2 minutes, 3 minutes of work in these different periods. It's not a lot you have to do, especially if you've already sort of made an inventory of these things that you have. It's really just checking and go, does that make sense? Yeah, it still makes sense. And you just keep moving. Annually, make sure that you're looking at yourself and this whole thing that you're planning for, this whole investment strategy that you've built, all of the estate planning and the financial planning, make sure it still lines up with the person that you are, because it's possible the person that you are could have changed in the last year or 5 years or 10 years, or just something is different about your perspective. So make sure that everything aligns. Make sure you complete a nice financial health checkup, reviewing all the accounts, the beneficiaries, estate planning documents, and all the financial relationships, and just everything to make sure that it's all in the right place. Same thing for that investment strategy and allocation. Make sure everything still aligns with your long-term goals and life changes. We talked about the case for staying invested, one of my favorite conversations to always have, because again, what we're looking at here is the case for staying invested through volatile markets from T. Rowe Price. So this was a study they did. This was a sort of what they looked at market data, and they looked at returns that happened after bear markets. So what you're seeing is different market bottoms. So as the market tumbled, it finally reached a point where it started to rebound from, right? So you have June in 62, June in 70, September 74, July 82, November 87, September 02, and March 09. Those were all times when the market was at its lowest for that relative time period when the bear market occurred. And you can see in the darkest blue bars, you have these big giant 30% returns, almost 50% returns, 60% returns that happened within 1 year of that bottom. And so the important thing is to understand that average return is 38.4%. When we have large bits of volatility, the large downsides and the large upsides usually come in the same place. when you have that giant downturn, that's when you're going to get those best upside returns that also add to the average. What the common retail investor will do that handicaps their returns is if you ride the volatility on the way down, you get scared and you sell out, then you miss these really high returns in the short time after. Then you invest back in. That was part of what generates your average return over 10 years, over 20 years, over even 5 years. That is a huge part of what actually gets you those average numbers, is sticking through it and feeling that best return after the worst return. So again, this is always my favorite thing to reference when people talk about like things look like they're getting bad. Should I sell out right now and move to cash? Missing the 10 best days of investment performance cuts returns more than in half. The 10 best days from 1980 to 2022. That's 42 years. 42 years of market returns. And if you miss the 10 best days, not weeks, not months, not quarters, not years, but days, your return is less than half of what it would be if you were invested for all of those days. So it's important to stay invested. And if you miss the best month's worth of days, it's, not even 2/10 of that return. Yes.
Does stay invested mean don't do a thing?
Yes. It means don't do anything. It's basically just the idea that you stay investing in the S&P 500. So you just put in your S&P 500 initially, and this is not accounting for any additional contributions or taking money out. So that kind of like adjusts things, but it's just a simple way to illustrate. Like if you put in that initial investment and you wanted to get, the best returns, the best thing that you could do is stay in there even when things get really ugly. It's a good reason to not overcomplicate your investment portfolio. Again, many of those stock market's best days happen during the market's worst years. You want to know when half of a stock market's best days are? During a bear market. Half of the best trading days, the best returns on the day are in a bear market. And another almost quarter of them are, another quarter of them are in the first 2 months of a bull market. So again, you remember that sort of scenario where somebody gets scared on the way down, they pull out, that bull market returns, and then they're like, okay, things are good again. They get in. There's a really high chance they've already missed out on those first 2 months. Most people wait too long to get back in, and they just end up missing all of that sort of that steep dive down and then the steeper dive up, or steeper jump upwards. So I just think good luck trying to time that. Like seriously, make it simple, keep it simple, stay invested. And if you're too risky, if that drop, whatever drop it is we're talking about, if it's too much for you, then obviously you have too much in risk on assets and it's time to adjust. So today we're going to talk about estate planning maintenance. I know we've already used up a decent amount of time just going back over that, but I just find that information to be so important. Today though, what I will say is we've got 2 documents that we're handing out. So one is just kind of a summary of all the stuff that we're talking about. So if you end up getting out early or start falling asleep at any point, don't worry. All of the important stuff is here on this document, so you can check that out later. And then we also have this organizer that we put together. So if you don't have a place where your important information is stored, things like, where your personal safe might be, a safety deposit box, medical records, social security card, passports, tax returns, healthcare directives, who your advisors are, who your attorney is, what your social security, all the stuff that your executor is going to need when you pass. All that stuff. Yes. We could probably send out a digital version of that. Yeah, I'll look into that. I'll get that sent out in an email. We'll see if we can make a digital version to put that together. But there's a lot of stuff like that. You can find more of them online if there's some stuff that's more of what you like, or I'm sure if you've got an attorney, they'd be happy to help you with that as well. But it's just a good thing to be able to organize all of that stuff so that when you eventually do pass and you have to put this job over to somebody else, that they have all the information that they need quickly in their hands to get the job done. So when it comes to estate planning, what we want to keep a close eye on is 2 things. We want to look at asset flow, where stuff is going, and asset control. So who is controlling that transfer or the use of it or any other benefits? So where assets end up and how they end up there. Where tends to be the easy part about this kind of stuff. But when we talk about how the assets are transferred, it can be more complicated and come with a couple details we need to sort out. Control means who is affecting the transfer of assets, use or other benefits. So it's super important to understand who has control and to what degree they have control over your assets both during and beyond your lifetime. These are the important things that we need to think about. So we have two things here for beneficiaries. We're just going to make sure that we're all on the same page here. So first of all, a beneficiary designation. A beneficiary is defined as a person or thing that receives help or an advantage from something, one that benefits from something. So really it's just the person who's going to benefit when it's no longer yours, or if it's named in some trust, who is the person that's going to get the benefit of the thing, which usually means income, use, or assets. So common accounts that have beneficiary designations. Life insurance, because that's the whole point of it. You have an insurable interest in somebody, or it's yourself or whatever. You get a life insurance policy, and then on your death within the term, it goes to the beneficiary, and they get those proceeds. Retirement accounts, so accounts that are like an IRA or a Roth IRA, those have beneficiaries as well. Work sort of the same way. If you're slowly drawing money out of there and then you die, that it can go straight to that other person, become a beneficiary IRA, and then they can begin to withdraw it themselves. Some income benefits, there are some income benefits out there, like some pensions and whatnot. Some of them will have like little bits of survivor income. So you have like a survivor beneficiary that will receive other income after your passing. And then of course, there's trust, which we'll talk about in a moment. So with a beneficiary designation, the financial institution that holds or custodies the assets is responsible for effecting the transfer, assuming they have the necessary contact information. So assuming that they have all of the right information to get it to the beneficiary, because if they don't have the information, what are they going to do? Assuming that they have all the right contact information and they can get in contact with the right person who is designated a beneficiary, it is going to be up to them to re-register the account, pass on the assets, and move them over. That's something that like we will do. If we have a client and they die and we know their beneficiary, we're going to re-register their account, however much goes to them, and give that to that new person so that they can take their money. Trust beneficiaries. The beneficiary of a trust often receives benefits in a more nuanced way. So it's not always put me on as a beneficiary of the trust and then I get all the money, or I get 20% of the money. A trust can have different types of beneficiaries, like an income beneficiary. So for example, if we're looking at something like a charitable remainder annuity trust, you might have something where you put monies into a trust, you put $1 million into a trust, you say invest it in income producing vehicles. It generates income, that income comes to the trust, but you're the income beneficiary. So you take the income out of that account every single year, or you take whatever predetermined payment amount it is, and it keeps going to you, keeps going to you. Then you die and there's several $100,000 left over in there. But the remainder beneficiary, the person who gets the remainder of the assets after you pass, would be the charity. And there we go. And then it's out of the estate and it goes to the charity that you designated. We'll talk about that vehicle a little bit more later. So you can have your income beneficiary, remainder beneficiary, or even a use beneficiary. So for example, with real estate, you might let somebody be a use beneficiary for allowing them to live in a property until they pass and it goes on to the next beneficiary. So with trust, you can get way more nuanced, you can get way more specific, and you can really create an estate plan that works for you. With trust beneficiaries, the trustee or executor is responsible for effecting the transfer of assets. And so this is going to be somebody that you choose. So it's very important to make a good choice here. You can get professional trustees. That's something you can pay for. So if you don't want to trust a family member or a child or whatever the case may be with that job, because the emotions of dealing with grief can often strongly affect decisions, you can get a professional trustee or executor to manage your trust after you go. But it's just important to understand, just like with something like an advanced medical directive, if you have medical wishes for if you become incapacitated and you're like, I just want you to pull the plug, man. But if you have somebody who's not willing to do that, but they're the ones who have control over that decision for you, it's tough, but it's a conflict. Very similar concept here. You want to make sure that when it comes to money, that you're not going to, make somebody who is a little, they've got sticky fingers. You don't want to make that person your trustee, because then they might start, because the trustees and executors, they can pay themselves for their time. Really important to understand is they can take reasonable distributions to pay for their time. And depending on what kind of power you give them, if you give them this general power of attorney to just completely use the trust assets however they see fit in order to distribute them to their beneficiaries, they might end up taking way more than they should have. So it's really important to get lined up with who's going to be this person. Now we'll talk about some account types, because these are basic things, but you'll see that the attachments are very important when it comes to estate planning. So you have your sort of individual retail account. It's just an individual account has the name of one and only one account owner attached to the account, which allows for the deposit of funds to buy and sell investment products or simply cash and cash equivalents. So this could also be a bank account, but I'm just talking from the perspective of an investment account because it's probably the easiest to understand. But this is also in regards to bank accounts. Then you have an individual account, but you have attached to it a transfer on death or a payable on death provision. So what this allows you to do is essentially add a beneficiary to that individual account. So if you want to do something really easy, you don't want to open a joint account and give somebody control of assets while you're alive and all this, you can just go, all right, I'm going to put a transfer on death on my individual accounts so that if I pass really quickly, like tomorrow or the next day, it's just going to get moved over to that new person and they'll be able to take those funds upon my passing. So it's a really good way to just sort of put on some estate planning without having to go create a whole trust, without having to do all that stuff. Making sure that you have your beneficiaries across the board is the number one thing you should do before you spend too much time doing anything else.
Death and EOD is the same.
Yep, they're the same thing. They're just called different stuff at different firms. I don't know why we haven't settled on one, but you'll see different stuff depending on what it is. You ask for one of them, they'll know what you're talking about. Next, we have two types of joint accounts. Number one is the most common because this is one that shares the same sort of attributes across all states, and that's joint tenancy with rights of survivorship, or you'll see this abbreviation that you're probably more familiar with. So this is a joint account with rights of survivorship. So a right of survivorship is basically saying that the person who survives has the right to the rest of the assets. It's shared by two or more individuals who have equal rights to the account. So the account is split equally. If one owner dies, the survivor automatically receives the decedent's share of the account. So if I put $50,000 in, one of you puts $50,000 in, and it grows by a bunch, then my half immediately goes to you when I pass if you survive me. Now, one thing about this is if you know anything about inheriting assets, you know that for taxable assets, things that are not in retirement accounts, you will get what's called a step-up in basis. So if I have an individual, let's say an individual transfer on death account, and I buy a whole bunch of Google stock and it's up by a whole bunch later down, years down the road, but my $50,000 has turned into $100,000. If I die and this then gets inherited by somebody, the cost basis, the $50,000 that I initially put in, is going to step up to the fair market value on the date of my passing. So if it's worth $100,000 when I die, now it's like whoever received it from me paid exactly what it was worth that day. So if they then sell it on the same day or just for the same value, they're not going to have any taxable capital gains. Now with joint tenancy with rights of survivorship, because the two people own the account equally, only the amount that is being inherited receives that step up in basis. So if two of us put $50,000 in, so we have $100,000 in basis, but now it's worth $200,000, only the $50,000 of gain on the person's share who died receives a step up in basis. So whoever survives, they still have capital gains, but whoever dies, it steps up and then it moves over. So it's kind of like you get half of a tax benefit with this type of account. But the other benefit is you don't have to have nobody has to be married. This can be whoever wants to own this account. Now, when we move into the next type of account, joint tenants in common, this is a joint account with tenants in common is shared by two or more individuals who have equal rights to the account. If one owner dies, there is no right of survivorship. So that's the difference here. This does not have a right of survivorship. The surviving person does not have a right to the rest of the assets. The decedent's share of the account will go directly to his or her estate. So this is more for just, this is if you want the person who owns it with you to get all of it when you pass, and this is if you want it to go back to your estate, and then it goes to follow your trust or your will or whatever you have set up in place. So that's the main difference between these two. No right of survivorship, right of survivorship. That's why the right of survivorship is right up there in the name. Yes.
Example. Joint tenants in common, would that be, sorry. Just a practical example of a joint tenant in common, would it be if there's, I don't know, a late life marriage and they have that, but if they die, they want it to go back to their estate so that their children then receive it?
Yeah, that could be a possible practical application. I have personally never actually seen a joint tenants in common account. If you have something to add to that.
The one that everybody recognizes, the tenants in common when you buy a cabin in Tahoe and there's like 10, 20 owners, and
Gotcha.
then I want to sell my interest or give it to my family.
Mhm. Okay, well, there we go. Okay, so now we're going to talk about two new, oh, yes.
The right to survivorship.
What about it?
That would be the best option for married couples.
Well, we're going to talk about two more accounts that actually have more to do with married couples right now. So I'm gonna hold on to that and we'll talk about that in just a second. So here we've got two other types of joint accounts. Now these are exclusively for married couples. So these are two accounts that are only available to legally married couples, which, you know, in certain states, if they don't recognize certain types of marriages, could end up being a problem for the benefits here. Just something to think about. But first of all, we have joint tenancy by entirety. So this is a joint account reserved only for married couples in certain states that permits spouses to own property as a single legal entity. So it's like the married couple, like as long as their relationship continues legally, that is the entity that owns the account. Each spouse has an equal and undivided interest in the property. This registration includes rights of survivorship. So if one spouse dies, it passes on over immediately. Creditors cannot enforce a lien on any property that falls under tenancy by the entirety if only one spouse owns the debt. This one's really interesting. So it's like the idea if husband and wife are building up assets together, they're building up this tenancy by the entirety account. But the husband, he's been very bad. And he went and he took on debt and he's gambling and he's doing all this horrible stuff and he's racking up this extra debt on the side. Now, those creditors can only take from his personal assets that are registered either by joint tenancy with rights of survivorship, joint tenants in common, the individual, any of those are vulnerable. But a joint tenancy by entirety account, those creditors can't enforce a lien on any property that falls under tenancy by the entirety if only one spouse owns the debt. Now, if they both take out way too much of a mortgage on a house and that goes under, that's going to be able to take the house and, clear out the debt that way. But this account, we don't have in California. We have something else. We have a different type of account called a community property account. So usually each state will have one of these two options. And not every state has either of these options. It really just depends where you are. These are pretty similar, but what we have in California is community property. So this is the one I'm more familiar with. So community property is a joint asset that was either acquired during marriage in certain states. So in certain states, if you're acquiring assets together during your marriage, they're automatically assumed to be joint assets and they'll get this treatment, or re-registered to community property during a marriage. So if you have, say, a joint tenancy with rights of survivorship account, you can convert that, re-register it to community property, and then it's going to receive the benefits described here. So assets excluded from community property are separate assets brought to the marriage, owned by spouses prior to the marriage, or assets inherited by a spouse during the marriage. Now, That's one very important caveat, is assuming they don't get commingled with, married assets. So if you have outside assets that were brought into the marriage before the marriage occurred that were accrued beforehand, those can be excluded from community property. And inherited assets also can be, but you have to keep them separate. They have to stay where they are. You can't start commingling them because then, well, it's become a marital asset. It's become part of that pool. So this is a pretty common discussion in divorce courts. That's where that gets important. Now, one thing, okay, well, I guess, are we going to get to that in a second? All right. Well, one thing that I will say is that with community property accounts, one thing that is very nice is that, remember how we were talking about joint tenancy with rights of survivorship? Only 1/2 of that account gets a step up in basis because it's only for the person who died. With both of these accounts, specifically, I don't remember if the joint tenancy by the entirety has this, but with community property specifically, when one spouse passes, the entire account receives a step up in basis because it's like, the couple that is the marriage effectively fell apart and died. And now the sole individual single person is the one inheriting these assets. So if you have monies in a community property account and somebody dies, immediately all of those gains get stepped up and there's no taxes. So it makes it much easier for the surviving spouse to deal with, which is why one of the most common things that we do, one is check the beneficiaries on all accounts. And then the second thing is look for joint tenancy with rights of survivorship accounts for married couples and switch them over to community property. Because there's not really any reason to do it another way. I mean, in my opinion, I don't know why you would give up the tax benefits if it's still the same thing. It's still rights of survivorship, but you don't get the same tax benefits. So if you're a married couple with this property, you would basically always choose community property.
Is that the only benefit? It's just that you get that step up?
Yeah, pretty much. Yeah.
So he didn't have, for example, stock or assets that had appreciated in his own.
Yeah, it doesn't matter so much. Yeah. And so we got two more. We got a trust account, which is an account opened by the designated trustee of a funded trust. So if you've got a trust and it's got a brokerage account, that's what this is, very similar. It's basically just like an individual account, but for the trust, for the entity of the trust specifically. Houses and other property like real estate can be registered in the name of the trust too. So people will do that frequently. They'll re-register their homes into the name of the trust to make it really simple for things to pass through. And then you've got custodial and guardian accounts. So this is really an account for people, either minors or adults, who are unable to manage their own investments. Usually it will be for minors, so for kids where, grandma wants to give them a little bit of stock, or, the fun uncle wants to give them some Tesla shares or something, or somebody has a mental or physical incapacity. So if somebody's actually unable to manage their accounts, you can also have a custodial or guardian account where a court-appointed fiduciary is required. For the minors, for the children, they'll usually pick the parents, just because it's pretty easy. They think it's a pretty reasonable that person's going to have the best interest of the child at heart. But if we're talking about, an of-age person who has a incapacity, that might be somebody else. So each state may have its own restrictions on this type of account, such as allowable types of investments and use of funds. So there might be a more limited selection of investment products that can go in here. Overly complicated investments are not going to be found in custodial accounts. Now we've got two different types of trusts. We've got a revocable or a living trust, and we've got an irrevocable trust. Main differences between the two. Revocable living trust is pretty easy to modify. It's really more of an organizational tool. It doesn't provide you with what people commonly refer to as protection. You're not protected from lawsuits and all this other kind of stuff just because you have a living trust. It doesn't do that. It's easy to modify because you still own the assets. In fact, a revocable or living trust actually reports via your social security number. So it's still just you. It's just another way to sort of categorize and organize things and have sort of like an instruction list to follow once you pass. That's why it receives what's called pass-through tax treatment. It's just passed through straight to you. All of the stuff that happens in a trust is taxable for you, and you've got to deal with it. It skips probate, which is nice. So if you want an easy way for assets to just not go through probate, a living trust is the way to go. If you want something easy to modify, like you're not fully sure on exactly how everything is going to plan out, revocable or living trust would be the way to go. But again, those assets are still within your estate. It's still, it's not removing it from your control. It's still something that you have access to. Now, an irrevocable trust, it skips probate and it's also outside of your estate. So it moves out of your ownership. It's actually not within your hands anymore. That's the point of having an irrevocable trust, is it's arm's length assets. You want to not have it within your control. And that means it's difficult or almost impossible to modify because you don't want it to be. You don't want to show that you have control over these assets because that's what keeps them outside of your estate and keeps them outside of the access from your creditors because they're not, it's not your money anymore. It's for the beneficiaries. It's not your money, so they can't take it from you because you have effectively already given it to the named beneficiaries on the trust. They'll also have their own tax ID number because it's a new entity. It's not just under your tax return anymore, and they'll pay their own taxes. Now, trusts have pretty high tax rates. So that's something that you're going to want to make sure that you manage. They can get, I think they can get up to 40%, something like that. So their tax rates are notably higher. One thing that can happen though with a trust is if income is paid to the trust and then immediately paid out to a beneficiary, I don't remember what the time frame is for immediately, but it's like, you know, hastily, like quickly when the income enters the account, pay it out to the beneficiary, it will actually only get taxed at the beneficiary's tax rates. So you can skip that trust tax rate by letting the income get out of the trust quickly. And so if you have something like, let's say, for example, you have IRAs that got inherited by a trust that are now going to pay out those IRAs as they take distributions to beneficiaries. If the distribution came out of the IRA and stayed in the trust, and we did not send it out to the beneficiaries, and we said, we're going to keep it here for a while. We're going to keep a little bit more control over this, and we're going to build up the funds, and then we're going to send it out over our own schedule. Say, for example, you're not comfortable with giving them the entire IRA over 10 years, and you would rather stretch it over their lifetime. You can't just do that with IRAs anymore, so you have to use a trust to accomplish that. The only problem is any income that's left over in the trust now gets taxed at the trust rate. So if instead you took all of the income or all of the distributions that hit the trust and they immediately moved out to the beneficiary, what you have, it's what's called a conduit trust, because the trust is simply acting as a conduit between the investments as the income hits it and it immediately goes out to that beneficiary and it skips getting taxed at the trust level. Anything that stays in the trust when it comes to earnings or things that income that has been generated, that gets taxed at trust rates. So it's something to keep in mind.
So does a living trust, a revocable living trust needs to be closed or just depleting the resources? Once it goes to beneficiaries, does it automatically die or is there any action needed?
So with a revocable living trust, generally what happens is you pass and then it converts into an irrevocable trust. So it basically, yes, terminates upon your passing and it creates a new irrevocable trust that will basically just follow the instructions of that revocable trust. But when it comes to all this taxation, all of that is, you know, after your passing. So when that irrevocable trust gets created, usually a revocable or living trust is just it's gonna be quick and easy, like it just distributes stuff out. It's usually for the more simple stuff. So that's not really much of a concern. And then it closes out when all the assets are gone.
Automatically?
Should, right? Or
If it's written in the trust, it would, but we've seen some trusts remain in place if it was intended to stay mom's trust, but pay out over time to the beneficiary. But most trusts do have instructions to give you a certain amount of time to get all the assets distributed. And if not, if it goes to an irrevocable trust, there's time to convert it.
yeah. So a couple terms to know about trusts. You've got three main things. You've got your grantor, which is usually you or the person who creates and funds the trust. So somebody that creates the trust as an entity or as the revocable trust and then transfers assets into it. That's going to be your grantor. You've got your beneficiary or beneficiaries, which are the people who are going to receive benefits from the trust. Could also be you, for example, something like a grantor retained annuity trust would be something where you put money in there and then the trust calculates some sort of annuity for you and pays you income over your lifetime. Then the remaining assets get transferred out to other people, whoever beneficiaries you have named. And then you've got your trustee or executor. That's the person or the company that manages the trust in accordance with the trust's terms. So you might have a situation where you have a trust, the person has passed, or it's an irrevocable trust, and there's a trustee who's managing it for the benefit of the beneficiaries. They can work with somebody like a financial advisor or an investment advisor and go, all right, I need you to take care of the investment accounts and manage them. That trustee is responsible for choosing the right people to manage the investments and making sure that everything is aligned for the beneficiaries. And then obviously the financial advisor is responsible to listen to the trustee. The financial advisor has really no obligation to the beneficiaries of the trust. They just have to listen to the trustee. That is the person really who is effectively acting as the client in this scenario. So it doesn't matter if a beneficiary comes in and goes, I want this all allocated this way and I want it paid out like this. I don't care. Read me the trust document and tell me what the trustee says, and that's what I'm going to do. So that's another part where you can kind of create another arm's length thing, and all has to be managed by the trustee, which is another reason why it's important to choose somebody that you can trust to do this job.
Okay. The accounts, the investment accounts. How do you bring investment accounts into a trust?
You will simply re-register them in the name of the trust. So when it comes to a revocable or living trust, that's a pretty easy process to do. That re-registration is simple. But when it comes to an irrevocable trust, what you're actually doing is gifting assets. So in the same way that you can gift me a certain amount of dollars every year and not have to file a gift tax report or all this other stuff, the same things applies to you putting money into an irrevocable trust, because it's like a new person. That entity is a new tax person, effectively.
So is there such a thing then as to have into a living trust some investment assets?
Yes, yes, you can have assets registered in the name of the living trust. Absolutely. Yeah, I have a couple clients that do that currently. There's a couple special types of trust that you can have. So charitable trusts are some of the more common ones. You'll have charitable lead trust, which has a specific set of assets that are directed to a chosen charity for a set period of time. So you're just moving those assets over today. It's like kind of doing it on the front end, and then you might get some remainder of that. Or if they use it for a certain period of time. And then the one that's more common, it's easier to understand. Usually what people actually want are charitable remainder trusts. So the idea is that you, the grantor, you're going to put your money into this trust, and usually you'll receive income. It'll either be a charitable remainder annuity trust. So they'll create an annuity just like an insurance company would, and they'll pay you out over a certain period of your life, over your lifetime. Or a or a charitable remainder uni trust, which I believe just passes out whatever income actually gets generated. So that could be different than the annuity payment. Then upon death, all of the assets go to that designated charity. But usually what will happen is you get the charitable deductions on the front side. So you get to get those charitable deductions for putting the money in the account, because you're effectively giving it to charity. It's just kind of not quite getting there yet. However, income that you receive back to you will be taxable because of that. So it's like you get the tax deduction to put it in, but then you're taking money out, and it's going to be a little bit taxable for you because you received that deduction. Then the remainder goes, and that just kind of disappears. Yes.
So if you have your directions and it's upon your passing, it goes to this person, but then anything beyond that, or X amount goes to, let's say you have 4 kids, they get each X amount, but beyond that, whatever's remaining goes to NPR or I don't know, Sacramento Blood Bank. Is that what that is? Or when you write that in the trust?
Yeah, so you can definitely, I believe that would probably be something like a charitable lead trust. So for the remainders, what you're normally doing is you're receiving income off of the assets.
Oh, okay.
Yeah, so that might be something that you more specifically write into, like just kind of your
Yeah,
own.
it's
Yeah,
written in.
Yeah.
So that this, and this are distributed to these people. If there's anything beyond that, it then goes
Yeah.
to this church that,
Yeah, that would just be
Yeah.
more of a feature of your trust. These are specific structures for the sort of purposes that are named here. Yeah. So this is usually like the reason that people like the remainder trust so much is because you get that tax benefit up front. Then you get to take little bits of taxable income off of it, and then the money just kind of disappears off to the charity. You don't have to worry about it anymore. You've also got a generation skipping trust, which is essentially that upon death, the assets will go to the trust. Income is paid to the first line of beneficiaries, so your children. And then when they pass, the assets, the remainder assets, will go to the grandchildren, so to their next of kin. So it's basically just kind of giving benefits to 2 generations at a time. You get the income benefit while this generation is alive, and then when they pass, the rest of the assets move on over to the grandchildren. Grant or retained annuity trust, one thing I briefly talked on earlier. Assets placed in the trust are used to pay an annuity payment back to the grantor. So there's a little bit of calculation that happens there about how much that annuity payment is going to be. And then the remaining assets transfer to the beneficiaries. So if you want to take your big chunk of money, stick it in a grantor retained annuity trust, you take off your lifetime income, then when you pass, whatever beneficiaries you've named, they'll receive everything else. So it kind of, pushes that off, just like the charitable remainder annuity trust. This is kind of the same thing. You're just not leaving it to charity. Another type of special trust that most of us will never have to deal with is an irrevocable life insurance trust. This type of trust is specifically used to hold life insurance proceeds. The trust will be both the owner and the beneficiary of the life insurance policy. So this removes the proceeds from your estate, which means that your estate doesn't have to pay any taxes on them. So usually what this will be used for is if somebody, assumes that they're going to have a $20 million or $30 million estate, and the estate tax exemption of right now 15 million isn't going to cover it, there's going to be some estate taxes that we need to pay, some death taxes. And so they'll create this special trust off on the side where the contributions go in there, and the beneficiaries of their own accord just so happen to buy life insurance on this person who has this giant estate. And then the life insurance death benefit will go to the trust. And because life insurance benefits are tax-free, it hits their tax-free. It's not in the estate of the person with all the money, so there's no estate taxes. And then the beneficiaries will take that and use it to pay for the tax bill of those giant amount of assets. I've never dealt with this because I've never, dealt with these ultra high net worth clients before, but it's one of those things that it's possible the premiums could be a whole lot less than that giant tax bill, especially because trust tax rates are so high. Another type of special trust that we can have is what's called a special needs trust. So a special needs trust can effectively give somebody benefits, give somebody assets without compromising government disability benefits, but it has to pay only for medical care or day-to-day needs. So if you do a regular trust or you just give somebody money, you know how there can be certain benefits where if that person has access to more than $2,000, benefits go away or get reduced dramatically. This is something that could help with that. So the idea is it has to be assisting a special needs dependent. So there's some qualifications, and it has to pay either for medical care or regular day-to-day things like normal amounts of groceries, normal amounts of this and that. So it can help them with their day-to-day expenses, but it can't go overboard. It can't do vacations. It can't do shopping. It can't pay for a lifestyle above just simply surviving. So it can help for all of that. And then if they have their own little source of income, they can keep that. So it helps boost their income by a little bit without compromising the benefits that they're already getting. Then you've got your spendthrift trust. Now a spendthrift, the actual term is about somebody who just has really bad control over themselves financially. They spend all their money. They just toss it out. There's no regard for responsibility. So a spendthrift provision in a trust is essentially something that tries to stop them from doing that so much. Because if you just put somebody as a beneficiary on your account and it's like a big, say you've got one of those individual transfer on death accounts, $1 million brokerage account. You've been managing it, you've been working really hard, transfer upon death, you die, it just shows up, it's access to them. They could transfer all that to their bank account today. No taxes either because they got to step up in basis. Now they go spend it on whatever they want. Now, you being the forward planning person that you are, knowing that it's likely that they're not going to spend this on things that you would like them to spend your hard-earned money on, you might create a spendthrift provision in your trust. So with this trust is going to maintain full ownership of the assets upon the grantor's passing. So it's an irrevocable trust. It holds on to the assets and it does not immediately pay out the assets to the beneficiaries. The trustee is tasked with managing the assets. Irrevocable trust. Normal stuff. The trust retains full ownership, and there's a special clause, which is the spendthrift clause, that dictates exactly how and when the beneficiaries may receive their portions of the assets. You want them to only spend it on college education? That's fine, you could write that in. You want it to only be spent on their wedding? That's fine, you can write that in. You want them to only receive it when they reach a certain age, have a certain educational level, and they're married? Go crazy. Do what you want. And you can write exactly how those beneficiaries are going to receive that money and really kind of just push them in the right direction, if you will. And you can dictate whatever you like.
Is it taxed?
Yes. So earnings that hit this trust are going to get taxed at the trust level, which actually, Bill texted me the tax rates for irrevocable trust income. So the first $3,000 taxed at 10%. But then the bracket immediately jumps after $3,000. So $3,000 to about $11,500, 24%. Everything from $11,000 to $15,000, see how small of brackets these are? 35%. Everything over $15,650 gets taxed at 37%. Federally.
Is that really great?
It can be depending on who you're talking to, but yeah, that's basically what you're trying to do, is you're trying to make sure that you affect control over those assets that they pass in with. Right, exactly. So it really just depends on how much you write into that spendthrift provision. You can be super complex and convoluted with it, or you can be fairly simple. It can really just be whatever you want. Because this is often where you might just set an age and go, just wait till you're 35, then you'll get it all. So you might do something really simple like that. Or you might layer on a whole bunch of things for different sections of the assets or whatever the case may be. So another type of trust is a testamentary trust, which is also called a will trust. This is essentially a trust that is only established on death because it's written into the will. The will exists and it says, open a testamentary trust when I die, and then it opens a trust, kind of like how a revocable or living trust turns into an irrevocable trust. This is basically the same thing, except for it's just written into the will. It avoids probate, but the assets are still included in the gross estate because, again, this trust didn't exist before you passed, and it didn't have control of those assets previously. So it's very similar to a living trust, but it's just inside of the will. So, estate planning checklist. This is not the same as the organizer that we gave out, but this is something that I pulled from NerdWallet. I like to use outside resources when I can, especially when they're helpful like this. So these are pretty much the things that you want to do when you do your estate planning. This is all the stuff you want to take, you want to account for. So you need an inventory of your assets. We need to know exactly what we're working with. What do we have? You want to account for your family's needs or whatever needs you're trying to fund. So we want to say, okay, what are the different things that we want to leave? Do we want to give certain beneficiaries a dollar figure? Do we want to give them a remainder percentage? What do we do in here? You want to establish your directives. So make sure what is it that we're going to do with this? How are we going to transfer these things? Review the beneficiaries, note your state's estate tax laws, and look at the value of professional help and always plan to reassess on the back end. So we're going to dive into each of these. So creating an inventory includes two things, tangible assets and intangible assets. Intangibles are going to be things like stuff that's just numbers on a computer screen. If you can't touch it and feel it, it's going to be an intangible asset. Ownership of a business, health savings accounts, retirement plans, life insurance, any stocks and bonds, checking and savings accounts, CDs, all that kind of stuff. It's intangible because it's not physical stuff you can hold on to. It's just kind of numbers on a screen. Tangible assets is going to be things like homes, land and real estate, vehicles like cars, motorcycles, and boats, collectibles, and other personal possessions. So you've got some really, really nice furniture that you still want to, it's not worth nothing. You didn't get it from IKEA. It's nice, heavy wood. You might want to include that as part of your inventory because maybe it's worth something. So accounting for your family's needs. One, make sure, of course, that you write a will if you don't already have one. There's even really easy ways to make a will online. I'm pretty sure there's free will creators that you can go sign up for because they're hoping that you use their other document creating stuff. Ensure that you have enough life insurance. So for most people that are, further along in sort of the second half of their life insurance is going to start getting expensive for the benefit that it provides. So it's something you might want to weigh a little bit more nuanced. But how much life insurance do you need? Depends on factors such as whether you're married or if your current lifestyle requires dual income. So the people who need life insurance the most are, dual income households that have children. That's like number one. Those are the people that need to have life insurance because if you lose an income, you lose the ability to support the family. And there's the grieving process, and there's just so much. So it's important for people like that to have life insurance. We're fans of term life insurance. Whole life insurance, universal, like they package a lot of benefits, but it just gets really expensive. Just there are a lot of stuff that you're paying for, and sometimes it feels like it's coming for free when really it's just coming out of the money you put in there that's supposed to be growing. I just like term life insurance because it's simple and easy to understand, and it's always the cheapest option too. Name a guardian for your children if they're minor children, and a backup guardian just in case when you write your will. So this can help sidestep costly family court fights that could drain a state's assets. So even if this stuff doesn't apply to you directly, really important conversations to have with children who have children. This is important stuff for you to contextualize and keep so that you can have this conversation with your beneficiaries as well.
Is there still, going back to universal versus term, what is the main? What is the universal insurance benefit in for retired?
Yeah, so when it comes to it's hard to name lots of benefits because one of the primary benefits that's usually leaned on is that they're permanent life insurance. They don't end, they just kind of keep going. But the whole reason that it keeps going is because all that money that you put in there, all that cash value that you accrued is still paying for premiums. It's not like it just becomes free. It's still charging you money along the way. It's just money you already put in there, so it doesn't feel like it's directly coming out of your bank account. The only times that I could really see benefits for, retired people's, if you've already got it, you don't need to surrender it and pull it back. You can allow it to stay there and pay the premiums for as long as it can. But the idea is hopefully that it credits a certain amount of interest along the way on the cash value that's in there. So because it has this sort of internal cash balance that's supposed to grow, that's supposed to help out. But oftentimes I would prefer just to buy the term and then invest alongside, just do it myself because, it's not that too complicated. So
Thank you.
yeah. So for a trust, establishing your directives, a trust might be appropriate for this. Again, for all of the reasons that we talked about, just kind of all this same stuff. With a revocable living trust, you put your assets into a trust and select a trustee to manage the assets for your benefit and that of your beneficiaries. If you become ill or incapacitated, your selected trustee can take over. And then upon your death, the trust assets transfer to your designated beneficiaries, bypassing probate, which is the court process that may otherwise distribute your property. And we know why we want to avoid probate is because they get to make the decisions for you. Like they'll do their best to follow what should happen, but if you're missing instructions for certain assets or somebody makes a really good case for why they should receive more and the courts go, yeah, it sounds about right to me, it can override your decisions even if there's a good enough reason. Usually like some sort of ex-spouse for childcare or something like those, mixed families and ex-spouses. That's where all this stuff starts to really become complicated, where it becomes really important to know, again, going back to that conversation of flow and control. How do the assets get there and who controls that? Really important. Medical care directive is also really important. So a medical care directive, also known as a living will, spells out your wishes for medical care if you become unable to make those decisions yourself. You can also give a trusted person medical power of attorney for your health care, which is giving them the authority to make decisions for you if you can't. And these two documents are sometimes combined into one document called an advanced healthcare directive. So that's just kind of putting that all together. Durable financial power of attorney allows someone else to manage your financial affairs if you're mentally or medically unable to do so. Your designated agent, as directed in the document, can act on behalf in legal and financial situations when you can. So this includes paying bills and taxes and accessing and managing your assets. Most power of attorneys will be written in the same way, which is a spring forward durable power of attorney, which means that it comes into effect upon some event, usually is medical incapacitation, and it's durable, meaning that it sticks around when you're incapacitated. For some reason, I guess you would want to have a power of attorney, if it's not durable, that only exists while you're actually able to make decisions. That person can also act for you. So, say you're just not locally around, you might be out of the country and you need somebody to make a decision for you. That's when, a financial power of attorney that doesn't have a spring forward, like it doesn't come into effect upon a certain event, that person can make a decision for you. And then if you want that to end when you become incapacitated, that's when it would not be durable. So it's durable if it weathers the storm of you being incapacitated and they can continue to make decisions. And it's springing or spring forward if it requires an event almost every single time, medical incapacitation, in order to go into effect. So most people are going to have a spring forward or springing durable power of attorney that comes into effect upon incapacitation and then sticks around until you pass, in which case the control all passes to the beneficiaries or the trustee or whatever you have set up.
Who defines that?
Defines what?
That you're incapacitated or that, when it takes effect?
Yeah, that'll just be basically a note from a doctor. So you'll need a medical professional, but yeah, you have any more specifics on how that functions?
A lot of them will say a note from 3 doctors who
There you
don't
go.
inspiring. But I usually say, who determines that? Your financial advisor, of course. No, 3 doctors or an attorney type.
Yeah. Okay, so we've got also a limited power of attorney. So we had these power of attorney, financial power of attorney, you got medical power of attorney. Now there's 2 ways that you can have power of attorney. There's general power of attorney and there's limited power of attorney. A general power of attorney is very much do what you got to do to make it happen. No restrictions on what needs to happen. If it's financial, they can do whatever they got to do. They'll pay your bills, they'll take money out of your accounts to pay for them, they'll do all that kind of stuff. But a limited power of attorney specifically limits the amount of power and control that they have over your assets or over whatever it is. So a limited power of attorney can be useful if the idea of turning over everything to someone else concerns you. This legal document does just what its name says. It imposes limits on the powers of your named representative. For example, you could grant the person the power to sign the documents on your behalf at the closing of a home sale or to sell a specific stock. So we can get really granular with a document like this. We can get really specific. So if we're thinking, okay, this is a really important decision that needs to be made no matter what, whether I get hit by a bus tomorrow or not, you can create a limited power of attorney that says, be able to do this action for me if I'm not available, and then give that to a representative who only has that power. So be careful about who has your power of attorney. They may literally have your financial well-being and even your life in their hands. You might want to assign the medical and financial representation to different people for several reasons, as well as a backup for each of those in case the primary choice is not available when needed. Because if your financial power of attorney is not available, if they happen to be on vacation when you get incapacitated and they're halfway across the world, it's going to be hard for them to, get communicating with who needs to be communicated with to affect whatever it is that needs to happen. So have backups and, really consider how these decisions are going to be impacting each person. And, it's not, splitting the medical and financial isn't always because they might think, it's like, well, I could pull the plug since I'm the beneficiary and I could pull this money. It's not always so evil. It's also just about how much those emotions can be affecting that person. I mean, being tasked with the responsibility of managing your medical care and to then also make the financial decisions, that person may want to rush the financial decisions so that they can focus on the medical care because they care about you more than they care about the money, right? But you might want somebody who's a little bit more focused to be able to take care of those financial decisions. Review your beneficiaries. So check retirement and insurance accounts. Retirement plans and insurance products usually have a beneficiary designation that you need to keep track of and update as needed. I mean, what happens if you still have, say, for example, an ex-spouse as a beneficiary on a life insurance policy that you think is going to come in, it's going to support your family, and looks like Sharon got all the benefits, and your kids are not going to see any of that because they're not named. So you got to make sure that things are updated and they are exactly where they need to be. These beneficiary designations typically outweigh what's in a will. So if a beneficiary designation says something and your will says something else, that beneficiary designation is going to win because it is a contract. It's following what's called contract law, which is essentially saying that there was a contract signed to deliver these assets to this person between you and this institution. A will is not as strong as that contract. So that beneficiary designation is going to win every time. Make sure the right people get your stuff. Sometimes people even forget the beneficiaries they named on policies or accounts established many years ago. Basically, my example for an ex-spouse as a beneficiary on the life insurance policy. Current spouse may receive none of the policy's payouts, and they might try. They might have to go through court to fight for those benefits, but you signed a contract to deliver the benefits to a specific person. It's really hard to override that. Don't leave any beneficiary sections blank. I believe I harped on this plenty previously, but if you leave a beneficiary section blank, when an account goes through probate, it could be distributed in any which way based on the state's rules for who gets the property. So make sure that every beneficiary spot has a person, and very important, name contingents as well. Backup beneficiaries are critical if your primary beneficiary dies before you do and you forget to update the primary beneficiary. Because if that person is unavailable, guess what it turns into? A blank beneficiary designation, and then it goes through probate again. Yes?
I mean, when you ask for beneficiary information, do you have to get social security numbers and all that?
Yeah, at least we do. We have to get social security numbers, so it's important. Yeah, and address. So all that, normal contact information and the social security number is something that's going to be necessary. It might make somebody a little bit uncomfortable, so you might want to prep them for that conversation. If you're opening up a new account and you go, hey, what's your social security number? That's not always how people like to have that conversation go. So be sure to kind of think about that ahead of time. So note your state's estate tax laws. At the federal level, only very large estates are subject to estate taxes. And we're not talking about estate or like trust income taxes. We're talking about a tax that you get when you pass just for having died. That's like the death tax and the estate tax. Typically ranges from rates of 18 to 40%. And this is on top of that income. So this happens first. If it's within your estate, you're going to have that all of this gets taxed and then it will pass to the beneficiaries. So in previous couple of years, it was 13 million, 13.5 million for the exemption. Now it's about $15 million. So if you pass more than $15 million to your beneficiaries, you might have a tax problem. But I kind of doubt that most of us are going to be running into that situation. And that's when you're going to start having those irrevocable life insurance trusts, remember? So that would be a reason to have that extra on the side. So what if you have a estate that surpasses the federal limits? Again, what we're talking about, grant or retained annuity trust. So moving those assets outside of the estate so that it passes in a different way, so that if you get assets out of your estate, they don't count towards that exemption amount. So let's say you have $30 million in assets. If you're able to slowly push those $15 million to an irrevocable trust outside of your estate, and then you're left with only the 15, well, both that trust and you get that 15 million exemption and there's no estate tax. But if you either wear down your exemption by gifting to more people than gifting more money than the allowable annual exemption, then you're going to start paying estate taxes on that. But again, most of us aren't going to deal with this just because of the sheer level of assets that's required to hit that number. But if you get some really good investment that pays off super well, I guess you might have that to be concerned about. Some states also have estate taxes, so they may levy estate tax when estate's valued below the federal government's exemption amount. There are some states where it's only a couple $100,000 where they start imposing estate taxes. And I believe in California we don't have estate tax. Is that correct? Yeah. No estate taxes in California, though. I know, right? Out of all places, you'd think, but they're nice to us for that. Some states also have inheritance taxes, so the people who inherit the money might need to pay taxes on it. And through that NerdWallet link, you can go read more about those things. We'll send that out. But it's important to also weigh the value of professional help when it comes to these things. If your estate is small and your wishes are simple, an online or packaged will writing program might be sufficient for your needs. Now, for the most part, if you've got lots of accounts that you could put beneficiary designations on, and you don't have complex desires of how the assets needs to be distributed, a simple will and beneficiary designations can take care of pretty much everything. Pretty easy to get through that. So these programs will typically account for IRS and state-specific requirements and walk you through writing a will using an interview process about your life, finances, and bequests. You can even update your homemade will as you might need. So another thing is if you have doubts about the process, it might be worthwhile to consult an estate planning attorney and possibly a tax advisor. These are going to be two of the key people when having this conversation about estate planning. These are going to be the two main things that you're worried about. They can help you determine if you're on the proper estate planning path, especially if you live in a state with its own estate or inheritance taxes. For a large and complex estate, think special child care concerns, business issues, or non-familial heirs, an estate attorney and or tax professional can help maneuver the sometimes complicated implications. So really just making sure that if you have complicated stuff that you're dealing with, if it's a lot, consult an attorney, really talk it through, and make sure you have a really good path towards success.
Okay, this is a question from Zoom. It's kind of a multi-part. The first part, is there a lifetime gift exemption per person or total for all the gifts beyond the annual gift exemption during a lifetime? And then the difference between the gift tax, estate tax, inheritance tax.
Okay, so I'm going to go to the first part and then I'll ask you to repeat the second part. The first part, when we're talking about that lifetime exemption, so that's going to be per person. So a single person will have that $15 million and a married couple will have twice that. They'll have $30 million of exemptions. Now, the annual exclusion is the amount that you're allowed to gift to a person every single year without filing a gift tax return. I don't remember what it is right now. I think it's around $19,000 or something like that. And you're able to gift somebody $19,000 and nobody has to worry about filing any paperwork or worry about it at all. If you start gifting more than that, two things happen. One, you have to file a gift report. So you have to report that to the IRS that you made that gift, and the amount over that $19,000 counts against that lifetime exemption amount that we have, the estate exemption. So if you gift $15 million of assets over your lifetime above that annual limit every year, then you start to reduce all that down, and then you get all the way down to zero, and you think, I'm gonna can pass and leave all these assets and there's no taxes. Nope, because you already used it all up. So it's important to understand if you're gifting to people, you can gift to as many people as you want, that 19,000. But as soon as that amount per individual crosses that threshold, that's when it starts eating away at the lifetime exemption. And so can you repeat the second part of that question?
Yes. The 15 million, is that per giftee or just in general, everyone that?
Yeah, so that's for the person who's gifting. It's
Okay.
their amount.
It's
So
their amount.
so it's their, if they gift more than that 19,000, if I gift somebody like $100,000, that 80,000 comes out of my lifetime exemption, which is that 15. So it reduces it by a little bit and then reduces it by a little bit. So it's what's coming from me, not the people who are receiving.
Okay, so 15 million per person, so they can't do 15 million one person, 15 million another person.
Correct. Yeah, it's going to be all the gifting that you're doing above and beyond the annual exclusion.
And what happens if you reach the exemption, what happens if you continue to give after that?
Oh, I can't remember if I've run into that. So you're gonna have to start paying gift tax,
Okay.
which I can't remember how it's calculated, but there's a little bit of gift tax that you have to pay. And usually, I believe it's a person who's gifting who has to pay the gift tax. But what you can also do, if you don't want to reduce that lifetime exemption amount, you can actually elect to pay the gift taxes before you start pulling it out of your lifetime exemption. So if you're worried that your assets are going to cross the threshold, or you're worried that the exemption is going to drop, like we were worried about this year with it in 2026 dropping to 6 million, but now it's been extended. If we were worried about that, if somebody has a $7-8 million estate and then it suddenly drops to 6, now we've got extra to work with. If you want to, you could take the extra amount that you're gifting and pay the gift taxes on it and say, I am willing to pay the gift taxes on it today. So it doesn't take anything from my lifetime exemption amount. Then when you get there, the 15 million is still all there. So I forget exactly what the gift tax rates are, but it is a little bit that you would have to pay after you complete that exemption.
Yep. And the second part is, what is the difference again between the gift tax, the estate tax, and the inheritance tax?
Yeah, so the gift tax is going to be essentially if you're gifting to somebody over the exclusion amount, you pay a little bit of tax for doing that because I don't even know why there's really a gift tax. So, but you do have to pay it. The estate tax is for when you bequeath your assets over a certain threshold, they get taxed. And then inheritance tax could be if you're receiving a certain amount of assets, then you have to pay taxes on that. But all of this really depends on the state. So plan to reassess when you're looking at your estate plan. Always look back, revisit your estate plan when circumstances change, for better or for worse, whether you got more money or less, you got a new marriage or a divorce, the birth of a child or the loss of a loved one, getting a new job or being terminated. All of these things are important to consider in your estate plan. Revisit your estate plan periodically, even if things don't change, just like we talk about with the investment strategy and the financial planning. Just keep looking, stay alert with what you got going on. And even if your situation didn't change, laws could have changed. Again, we talk about this with the tax code, but like I just mentioned, we were worried about that 14 million estate exemption, gift exemption dropping to 6 million. That's pretty substantial. There's a lot more people with estates between 5 to 7 million than with above 15 and 20. That starts getting to closer to the mass affluent people of the world. We're drawing to closer to that range. So that was going to be a really big thing that could have, made a big difference, especially if that person is invested in assets that have significant appreciation potential. If they're not that old and they've got time to invest, those assets could increase substantially. It will take some effort to revise your plan, but take heart. The need to revise means you've already avoided the biggest planning mistake ever, never drafting a plan at all. So that's the most important thing, to just make sure you have a plan in the first place. And with that, that brings us just about right to our ending time for the day. And I know that was a lot, but I hope it was helpful. And we'll be around for a little bit if you've got additional questions. Thank you for coming.